Back when I was but an investing spring chicken in 2019, I accidentally filed my 2018 taxes without waiting for my 1099 div forms. Oops. I later learned from my dad that I would need those forms to report the income from my brokerage accounts, which affected how I settled up with the IRS. So, to save you from making my mistake, we are covering all things investment taxes today. With that, my friends, I have good news and I have bad news. The good news is that investment taxes are a lot simpler and easier than you might expect. The bad news is that you are about to hate your earned income by comparison. Let's get the really good news out of the way first, shall we? Unless you're retired and drawing down on your retirement accounts, you don't have to worry about your 401ks and IRAs during tax season. Your 401k and IRA are great tax-advantaged investment vehicles for a few reasons. For one thing, you aren't taxed on the growth in those accounts every year the same way you'd be taxed on it in your taxable accounts. After all, that's kind of the point. So what does this mean? You can buy and sell and rack up dividends and interest inside these accounts without worrying about paying taxes annually on any of it. It's all tax sheltered. So if you're going to try your hand at high frequency day trading or high risk investing, your Roth IRA might be a great place to do it. Just ask Peter Thiel. That's a joke. Please don't day trade. The point is, if you do all of your investing inside retirement accounts, nothing I'm about to say really applies to your situation. We really only need to concern ourselves with investment taxes during our accumulation phase inside taxable brokerage accounts. And a note. The term taxable gets its name from the fact that it refers to pretty much everything that isn't a tax-advantaged retirement account. So if you have brokerage accounts, what do you need to know about taxes? If you contributed to one over the last 12 months, it's likely that you experienced some gain or loss. For example, if you invested $1,000 in March 2022 and today you have $1,200, that $200 difference is your capital gain. It's the gain that your capital of $1,000 earned. And for most index fund investors, growth will be composed of two things: capital gains, where the asset went up in value, it's now worth more than when you bought it, or dividends, which you can think about like a token of appreciation from a company. The company is essentially distributing its profits to shareholders directly, and some companies offer higher dividend yields than others. For example, if you buy a $20 share of a company that offers a dividend yield of 5%, you'd earn $1 per share. The important thing to know is that capital gains and dividends are taxed differently than earned income. And if you're just dollar cost averaging into an account and you're not selling anything, you won't pay taxes on the capital gains portion. You only pay taxes on capital gains when you realize them, which essentially means when you sell at a gain for any reason. Now you may be wondering, if I'm selling something within my brokerage account, but then just using the money to buy something else and I'm not withdrawing anything, do I still have to pay taxes on the gains? And the answer is yes. Even if all the money stays within the confines of the account, those realized gains and losses from buying and selling still trigger a tax event. So let's talk about how capital gains are taxed when you finally sell. Your capital gains are taxed based on how long you held and your total income from all sources. So think your salary, your side hustle, your investment income. Add it all together and imagine stacking the capital gains on the very tippy top. Here's the breakdown. If you sell in less than 365 days, so 1 year, you'll pay your marginal tax rate on the gain. This is definitely suboptimal and should be avoided if possible. For example, if we had sold our $20 share at $25 after 6 months and we're in the 24% tax bracket, we would pay $1.20 in taxes on our $5 gain, gross. Of course, it's still better than nothing. You still have $3.80 you didn't have before, but you're less ahead than you would have been if you had waited or sold older shares first. Now, if you sell after 365 days or 1 year, you'll pay the capital gains tax rate on the gains. And the capital gains and qualified dividends tax brackets are a lot easier to navigate than the progressive tax system and can be way more forgiving. That's the good news about investing. So if you as a single person in 2022 had $41,675 or less in total declared income, you won't pay any taxes on your long-term capital gains. For married filing jointly, the 0% bracket covers up to $83,300 $750 in total income in 2022. If you have between $41,676 and $459,750 in income in 2022, yes, that's not a mistake, $459,000, you'll pay 15%. For married filing jointly, it's $83,351 to $517,200. And if you have more than $459K or $517K if you're married in income, you'll pay 20% on your capital gains. Because of how broad it is, most people do fall into that 15% category. So remember our $1.20 in taxes on our $5 short-term capital gain before? If they were long-term capital gains, we'd pay just 75 cents. Even if you're bringing in $400,000 per year as a single person and you would be in the 35% marginal tax bracket on earned income, your investment income, your realized capital gains, are only taxed at 15%. But what if you've been dollar cost averaging into various holdings over time? If you've been adding little by little, how does the brokerage firm know what to sell? The shares I bought last week or the shares I bought 3 years ago? My gain will be different depending on my cost basis or the amount I paid for it. So how do I know? Brokerage firms typically use FIFO, first in, first out automatically, though it's definitely worth a little Google for your brokerage firm. But this basically means they'll sell your oldest shares first to satisfy a sell order. So if you bought something 3 years ago that has a $5 gain and more of it last year and that has a $2 gain, it'll sell the older shares with a lower cost basis and in this case higher capital gains first. Firms like Betterment make this pretty easy too. They'll warn you of the tax impact of selling before you press any of the scary buttons, and they will confirm that you still want to make the move. But let's circle back to those dividends because they are taxed a little bit differently. Your dividends will be taxed annually whether you reinvest them or not. That is, whether you keep them in the account and you set them to reinvest or you withdraw them. You pay taxes regardless because they are always considered income in the year that you earn them. So there are two types of dividends. There are ordinary dividends that are taxed like ordinary income. In other words, you will pay your regular tax rate on these bad boys. And then there are qualified dividends that meet certain requirements and are taxed similarly to capital gains using the more forgiving brackets described before. Your 1099 div that you receive from the brokerage firm, so, the form that I didn't wait for in 2019, will clearly outline both your qualified and ordinary dividend amounts. Now, it's important to note if you've set your dividends to reinvest, which is generally the advisable thing to do, you are technically being taxed on income that you never withdrew as cash, which is different from the way that you're taxed on the income you receive on your paycheck because you'll essentially need money from another source to pay a tax bill associated with your dividends that you've reinvested. This won't be much in the beginning, but if you have a huge brokerage account worth hundreds of thousands or even millions of dollars, you could theoretically generate a dividend income tax bill in the thousands. You may not need to sell any holdings because you need cash, but you may find yourself in a position where you need to sell in order to rebalance your portfolio. Rebalancing is effectively saying, okay, my goal was to own 90% stocks and 10% bonds across my portfolio, but 5 years have passed and my stocks grew way faster than my bonds did. So now my actual allocation is 95% stocks and 5% bonds, which might be just a little bit too risky for your liking. So in order to get back to your goal allocation of 90-10, you really have two options. Number one, you can sell stocks and use the money to buy bonds, or if you're still contributing and growing those accounts, you can contribute your new cash in such a way that it buys more bonds than stocks for a little while until your bond allocation is larger. Keep in mind though that it's helpful to think about your portfolio holistically as the sum of its individual parts, because it's a lot easier to buy and sell within those tax advantaged accounts. So it's possible you could handle the majority of your rebalancing within those accounts, depending on how much you have squirreled away in them. In a scenario where your money is primarily allocated to tax advantaged accounts, you may decide to venture over to a 401k and offload some of your longest held stocks to reinvest in bonds and leave the brokerage account alone. If you find yourself rebalancing, you just have a few considerations. The first is to try to rebalance within the the tax-advantaged accounts where you won't get dinged with capital gains taxes. And the second is to be mindful of the upper capital gains tax bracket where you'd creep into that 20% territory. If you're a high earner and or selling a lot at once to rebalance, you want to ensure that you don't accidentally breach the upper limit of the 15% capital gains bracket and begin paying 20% on some of your gains. Ideally, rebalancing is something that can be done little by little over time rather than all at once. So far, we've mostly talked about how taxes affect your investments if your holdings are up. But what if your stocks are down? If you invested money that's at a loss, for example, how most of our portfolios looked at the end of 2022, tax loss harvesting is effectively what happens when you say, hey, I invested $100, now I only have $80. I want to take a tax deduction on that $20 I lost to help ease the pain of failure. Just kidding, you're not a failure, you're just an investor who is along for the long haul. But here's how it works. You sell a holding that's decreased in value so you can recognize a capital loss. Your 1099 div should also list your capital losses, which can then be used to offset gains from other investments. That said, this maneuver is accompanied by a pretty complicated set of rules, so if you want the deeper dive, listen to the full episode or consult your CPA. Otherwise, let's bring this thing home. Should taxes scare you away from investing? Well, would you turn down a raise because it means you're going to have to pay taxes on the incremental money? No, probably not. Our discussion today is a pretty decent support case for maximizing your 401k and IRA contributions first, since the ongoing tax situation on those bad boys is pretty simple. But for everything else, there are ways to help minimize the pain. First and foremost, try your best not to sell assets that you've had for less than a year. That's one great way to help minimize your tax liability on growth, since once you cross the 1 year mark, you'll be dropped down into those sweet, sweet capital gains tax brackets. And what can you expect at tax time? Well, most firms will send you something called a 1099 div or maybe a 1099 composite by mid-February. And this will list your capital gains, your ordinary dividends, your qualified dividends, any capital losses, and that's what you'll upload to your tax software of choice or give to your CPA. And even if this feels like a lot to manage for yourself, you have options. If you invest with a robo-advisor, it's likely they'll have automatic rebalancing and tax loss harvesting features that you can turn on so you don't have to worry about doing any of it manually. Plus, your 1099 div forms will spell out the results of each account for you, so get familiar with them. It is relatively easy to plug the numbers into tax software, but there's also no shame in hiring a CPA to handle it for you. They can also answer questions and make suggestions that may lessen your tax burden. And remember the best news of all. If you're making enough income from your investments to be taxed on it, you are officially in rich girl territory. Embrace it. If you want to hear the full episode of this week's Money with Katie show, click the video that just popped up on the screen and in the description of this video. Our show is a production of Morning Brew and is produced by Henna Velez and me, Katie Gatti-Tassan. Devin Emery is our Chief Content Officer, and our video editors are Christine Muldoon, Sebastian Vega, and Nicole Friedman. Additional fact-checking comes from Kate Brandt.